Welcome to Talking Personal Wealth Management podcast. My name is Leah Crowley, and in this series we're taking a look at a range of topics that you might know a little bit about but want to get a better understanding of. We explore all areas of personal wealth management, including investing, estate planning, financial advisory, self-managed super funds, insurance, and financial life cycles. Today we are joined by Betty Preshaw, Director in the HLB Debt Advisory Division. Thanks for joining us, Betty.
Thanks, Leah. Lovely to be here.
Now, Betty, we'll be talking about interest rates and, fixed and variable, all the stuff that I'm sure you have to answer every single day, but we're going to make you do it again today. But before we do that, maybe just a bit of a background in your professional life.
Okay, thanks, Leah. So I'm a lender by trade. I've been lending money for over 25 years now. That says my age. So I worked for the major banks for about 20 years, and then I started up a mortgage broking business 8 years ago. I was a sole trader. And about 3 years ago, I joined the HLB Debt Advisory Division as a director and a mortgage broker.
Yeah, right. So your background definitely indicates that you know who to go to, what answers are needed for particular people, because I would imagine every time someone wants to buy a property, their circumstance is different.
Absolutely. So I've seen lots of changes in the industry over my career. When I first lent money 25 years ago, interest rates were at around 18%.
Oh my gosh.
And today I've lent money at 1.84%. So what a difference, right?
Yeah, absolutely.
Yeah.
And yet somehow it can feel daunting, but yet somehow it always works out, right?
Absolutely.
Yeah.
Exactly. So times have changed. Borrowing money today is certainly harder and way more complicated, with a lot of questions and assessment required when servicing a person's capacity to borrow money. But if you've got the right person in front of you, the whole process can be made quite transparent and easy.
Is that just because you're amongst it every day and you've been amongst it for 25 years, so you've seen the changes and the new things, the old things and everything, where somebody who maybe they bought a property 25 years ago, right? And they haven't bought another one since, and now they're going to. They would suddenly have to be like, all right, I'm just going to find out everything there is to know, where you already have found all of that out.
Yeah, I guess so, yeah. So there's so many little variables when it comes to borrowing money. Residential debt can be quite complicated. Everyone's position is so unique. Going to one lender specifically is probably not going to be the best way to go about borrowing.
But it's true, right? Like, you can't just go to one shop, I'm going to say. It's like, one bank and be like, okay, can you do exactly what I want? No. All right, then I just won't do any home buying.
Yeah, well, true, right? So even if every single lender suited your specific need, going into one shop or one lender and negotiating on the best rate for you is not necessarily going to be the best product or rate when there's so many lenders out there. I deal with over 25 different lenders.
Wow.
I don't necessarily use every single one of them.
But you know them. I don't know them.
I have access to them, right?
Yeah.
So I have access to their policies, to their rates, to their fees. And every lender has so many unique variables, particularly around policy. Every lender has their own niche and every lender has their own product and rate, and it's not necessarily the same. The variance across the lenders is so large, and specifically, particularly if you stay with your one lender, like you've probably heard of the loyalty tax that the banks charge.
No, hang on. What? Loyalty tax?
Yeah. So the longer you're with your lender, it's highly likely that you're paying too much for your debt. So it's been labelled the loyalty tax, right? So if you've been with your lender for 2 or 3 years and you are on a variable rate loan, then it's highly likely that you're paying a much higher rate than the most competitive rate on the market today. So the most savvy of borrowers usually shop that around and take it back to their lender at least and renegotiate on that rate. And most lenders are up for renegotiation, and sometimes, you can still remain with your current lender to be on a competitive rate, but actually keeping your lender on their toes by constantly reviewing your own debt or asking someone else to do it, like a mortgage broker or mortgage advisor such as myself, is probably going to be the most efficient way of doing it.
It's not sort of sign, just make payments and we're done. Like, it's in your best interest to continuously keep an eye on these things.
Yeah, particularly if you've got a variable rate loan.
Yeah.
So the options for debt are variable rate or fixed rate. The fixed rate loans are a set and forget product. So set and forget for that fixed rate period. If you fixed your home loan for a 2-year period, for example, then you can just forget about it to some degree because your repayments for the next 2 years are guaranteed. You know that your rate will remain the same even if rates go up. Even if they go down, your rate will continue to remain the same. It is a very structured product. It is a contract that you enter into with the bank, and therefore for that fixed rate period, you don't want to be deviating too much from that product because it can be quite costly.
Are there ever situations or circumstances where people might do the fixed rate for, like that 2-year or 5-year or whatever contract, and then they think, maybe not the shop around, but like go to their bank and say, or their lender, I should say, and say, what are the variable rates like now? Could we swap over to variable for a certain amount of time? Is that a thing that people do?
You can, but if you're within that fixed rate period, you probably don't want to be breaking that contract.
Just because of a fee or something?
Yeah. So what happens is when you take out a fixed rate loan with your bank, depending on the fixed rate period, say it is a 2-year period, you are basically signing a contract with your lender saying that I'll make those repayments for the next 2 years. And if for whatever reason a sale of a property or you want to refinance because rates have dropped and you want to take advantage of a rate, then it's highly likely that the bank will charge you break costs, and they are economic costs to the bank, and they can be in the thousands of dollars. The bank will not tell you on day one what the break costs will be because it depends on the time of breaking that loan, what your break costs will be. But I've had clients in the past wanting to break a 5-year fixed rate loans because rates just dropped so low unexpectedly, but found that by breaking that contract, they were going to be paying thousands of dollars. So, and sometimes it's actually might be worth your while because some of the lenders offer these cashbacks as an incentive to come across to them. So there might be a $4,000 cashback if you refinance your loan with an incoming lender. And if your break costs are $4,000 or less, then it might still make sense to refinance your debt across to the sharpest rate. But usually a $4,000 break cost is, for me, it's actually not necessarily as high as what I have seen.
Oh, really? Like how high can it go?
Depending on the debt, right?
Yeah,
so
of course.
If you've got a $900,000 fixed rate loan and you want to break it, I mean, that could be, $20,000, a lot of money, depending on what it's the economic cost to the bank.
So obviously we've touched upon it, but fixed and variable, like fixed, we've got the contract, that's how much we're going to pay percentage of interest for 2 to 5 years or something, right?
Yep.
And variable is we're going to go with whatever it is this week.
Product. Yeah, exactly. So when you borrowing money, when it comes to borrowing money, the lenders look at 2 factors, right? I'll start with the beginning. So when it comes to borrowing money, lenders look at 2 things. They look at your income and they look at your expenses, and therefore determine your capacity to repay debt. And then the second factor that they look at is security. And security means the property that you're purchasing, and the banks take a charge over that property. The lenders like you to have usually 20% equity in that property. So they will lend you up to 80% of the value of that property. So your loan to value ratio is usually around 80%. Well, that's what the lenders like. Now, anything greater than that, you can borrow potentially up to 95% of the value of a property. But then you must pay a one-off insurance premium called lender's mortgage insurance. And this is basically insuring the bank for that extra 15% the bank will be lending you in case things go sour. So, and it is costly. Lender's mortgage insurance is an expensive insurance premium. It's a one-off premium and it is expensive, but some people do it and you can add it to your loan potentially as well. So they're the two sort of variables that come into play when borrowing money. The next factor is, well, when my clients usually come to me, they'll say, Betty, what's my borrowing capacity? How much can I borrow? And then after we determine how much they can borrow, and that's obviously looking at their equity position as well, the next thing we look at is the products, right? So then you've got two products that you generally use, which is a variable rate loan or a fixed rate loan. Yep. The fixed rate loan in the past, these past several years, was probably the sharpest rate on the market. So if you wanted to take advantage of one of the sharpest rates in the market, you probably fixed your loan. So, I mean, there was a time where fixed rates there was a 4-year fixed rate last year at 1.89%. What an amazing rate, right? You know, you can't go wrong. So in that instance, a whole bunch of borrowers went in and fixed their debt. It was one specific lender. So fixed rate loans give you certainty of repayment. You know that in a rising market that the rate that you have won't go up, but also if rates drop, your rate won't drop, as we've just talked about. Fixed rate loans are very structured. They do not allow for extra repayments, and if you do make extra repayments, then you're probably up for large break costs, but they give you the certainty of repayment. So, for example, I have clients that have children in childcare and they know that in 2 years' time when their children go to school, they will no longer have these exorbitant childcare fees. So they've come to me and they've said, Betty, you know what, we just want to fix our loan for the next 2 years because we know our childcare fees will be X and we just want to have certainty of repayment on our debt. So we're just going to fix it at that prevailing rate. And so we fix it. And then after the 2 years, they might, when their kids are in school, they can actually start distributing that extra cash flow to their mortgage and start reducing that debt. And in that instance, they would take up their variable rate loan. In today's market, the variable rate loan is actually the sharpest rate on the market today. So there's some pretty sharp rates at the moment. A variable rate loan is a very flexible product. You can repay as much as you want on the debt. You can redraw debt a lot of the time. Some variable rate loans have the benefit of what they call an offset account. And an offset account means that you have a linked transaction account to your home loan, and every extra dollar that sits in that offset account, it's as though it's sitting in your home loan. So if you had your pay go into your offset account, for the period that your money sits in that account, it's as though it's sitting in your home loan. And over a period of time, when you know, over the years, having your pay sitting in that account for a few days or a few weeks or whatever it is, it actually works out that you do save quite a bit of money. So there are loads of advantages of having an offset account linked to your variable rate loan. So
with the offset account, let's just say your pay is not going into it, but you're putting X amount of dollars into it each week or each fortnight or whatever. And say you've got a variable rate, so it drops and your repayments are not as much as they have been, you know, previously. Do people sometimes just continue to put the same amount of money regardless of what the rate is, just so that they've got it in their offset account?
Well, my recommendation to my clients is that when you have your variable rate loan and your offset account, that you have all your pay go into your offset account, and that you use it as you would normally, right?
Sure.
In fact, what you could potentially do, the best setup would probably be to have your variable rate loan, your offset account, and to have your credit card as well. I'm not condoning credit cards, but usually what the lenders have when they offer a variable rate with an offset account is a package, and you pay an annual fee for a package, and it's around $395 an annual fee for having this package. And the package includes your variable rate loan, your offset account, which is a fee-free offset account, and a credit card. It's a fee-free credit card as well. And so the best setup, I believe, for most clients is that you have your pay go into your offset account on a fortnightly or weekly or monthly basis. You use your credit card for your daily expenses, and at the end of the month, you clear your credit card. So for the whole month, you're using the bank's money at effectively no cost. You have all of that money sitting against your home loan, which is saving you money. And at the end of the month, you're clearing your credit card. So I don't believe in hanging on to credit card debt because that's an incredibly costly process. But clearing your credit card on a monthly basis and having a fee-free credit card attached to your home loan, it's quite an effective way of running a household, I believe.
Yeah, right. And how many? I mean, is this the kind of setup that a lot of the banks and lenders provide, or is it sort of?
Look, it depends. There's so many products out there, Leah. Truly, there are thousands, and everyone's situation is so unique. Some people say to me, Betty, I just want the sharpest rate on the market, right?
Yeah.
I just want you to get me the sharpest rate. And if the sharpest rate on the market is usually, well, in today's market, it's probably not going to be the variable rate with an offset account, because mostly the lenders do apply, say, 10 basis point premium on top of a variable rate loan for this service, right?
Okay.
But a lot of the times they don't. But, sometimes it's not the sharpest rate on the market is usually going to be just a no-frills, cheap home loan where there's no offset account, there's no credit card linked. It's just a variable rate. It's the sharpest rate on the market, and then you just reduce that and you have redraw capacity. So everyone's situation is so unique. Some people will say, we've only got one mortgage, we've got our offset account, we want our credit cards, and that's the way we want to run our expenses. Then there's obviously the owner-occupied and the investor variable as well.
Yeah, I was going to ask this because this would be a whole different ball game, right?
Yeah, exactly. So, I mean, I've had clients that have got an existing mortgage for owner-occupied purposes, and then they've got their investment home loan as well. And in that instance, you probably don't necessarily want to have an offset accounts linked to your investment home loan. You probably just want all of that extra money going to your non-deductible debt.
Yeah, okay.
And the investment home loan being charged the interest because that's deductible debt, right? So, these are the structures that you sort of can play with as well. Yeah.
Like you said, there's all these different variables, but what happens if there's an owner-occupier and they're almost finished paying off their mortgage for their primary residence, and then they want to purchase an investment property but need to get a mortgage on that? Is that different to someone who has already paid off all of their primary residence and now they're on to their second investment? These two people, I assume, need very different things, right?
So if you've got an existing residence that's got no debt against it and now you want to buy a second residence, we go back to that initial scenario where we have to look at your equity position, right? So if you've got no debt on your current residence and you're looking for an investment property, you would need to have some 20% deposit, in cash. So in today's market, particularly in Sydney, 20% to put towards a house in cash, it's quite a bit of money, and especially if you've got an unencumbered property. So in this scenario, what usually happens is that your owner-occupied property can secure your investment property.
Now that sounds scary to people, but it's not really, is it?
No, because it does in the scenario you've just talked about, where you've got an unencumbered residence, you've got no debt on your current house, and you're looking to purchase an investment property. So you could potentially borrow 100% of the costs of that investment property, including the stamp duty. And this is what I've done for many of my clients. So $1 million property, let's say, for example, $40,000 stamp duty. So you could potentially borrow $1,040,000, assuming you have equity in your house, which would be the $200,000. You could secure this new debt by your property that you live in and the property that you're purchasing. So the bank has two security properties for this overall debt of $1,040,000. Obviously, you need to be able to substantiate servicing that debt and everything else that comes into play when assessing borrowing money. But that's a structure that that could work, and that a lot of people do. Most people do. A lot of high net worth individuals do that quite a bit. Some people don't like to link their property that they live in to an investment property, but I guess you need to have the equity in order to not link it, to have it discharged and have an owner-occupied property just that sits unencumbered, and then you have your investments separate and potentially linked as your property portfolio potentially grows.
Yes, so many different. Yeah, you got to have all the factors.
Yeah. There's so many scenarios. Like I can just rattle off a few if you want me to. But there are some. In terms of policy specifically around self-employed people, for example. So most lenders will require, for a self-employed borrower, will require 2 years of financial information. So historical financial information. So in our current year, so they would a lender would need to see 2021 and 2020 financial information, and obviously consistencies in that income to substantiate your capacity to borrow. Whereas there are a few lenders out there that'll only look at 2021. So if you have had a really strong year because COVID's been really good to you, and you know that your business is now going to grow from strength to strength, and you now want to borrow money for whatever reason, investment, owner-occupied, then there are lenders out there that will look at 2021 income only and go, right, based on this year, you've had a gun year, we're going to, lend you this money. There are other variables, obviously, that come into play. So, the ABN needs to be registered for at least 2 years. There's other factors and everything else. It can't be a startup.
Yeah, right.
But there are lenders, right, that will look at just your most recent financials
but it's kind of like your resume, right? Yeah. And you go, I was really, really good at all of these things. But you kind of got to back it up. Yeah. So it's kind of a risk, if you think, 2021 wasn't really the norm for me, and I'm not sure what 2022 or 3 is going to be. I hope it's going to be as good, but you're not really sure. Is that a risk worth taking?
Yeah, exactly. So, for example, right, let's just use an example where a business makes masks for COVID.
Yeah, great, right?
Because when COVID ends, there's going to be no masks. Let's just assume there won't be any more masks. So if this business is purely a mask business and has super strong financials for 2021 because their masks are just selling out like nuts, then I probably would not be taking it to lenders, because the lenders will go, well, hang on a minute, that's an industry that's probably not going to prosper because we're hoping that COVID's going to go soon. So, that's just a little example. So you're right. There's a story behind every application, and it's I'm the story writer. Well, I translate my borrower's story onto a document and I put that proposal forward to the bank. But my job would be to understand my borrower's unique situation and ask them all the relevant questions and ask them what their strategy is for growth, for example, and get a really good understanding of their business if they are self-employed or if they're PAYG. And ensure, that I'm lending money responsibly and knowing that money will be growing or at least be consistent for the next 30 years, because that's usually the term that people have when they borrow money. So it's usually around a 30-year loan term, depending on your age, of course. Yeah.
And this goes back to, I think, probably what you would find in the FAQs, right? Like the most frequently asked question. So if you've got a fixed loan, 30 years, and you're like, I'm going pretty well. I want to put extra. I want to pay more. Yeah. More repayments. Is that possible in a fixed loan?
It's around $10,000 a year to a maximum of $20,000. So if you've fixed your loan for 5 years, you probably can only pay up to $20,000 in extra repayments. And that's usually consistent across the lenders. Some lenders are a little bit more lenient and aren't as strict, but mostly that's usually the rules. It's a $10,000 and that's it.
And that's it, because it's a contract. You've signed that contract.
Yeah, that's right.
Yeah.
So, I mean, a lot of my clients will split their loan and so in today's market, for example, we're all sort of going, oh, rates are going to go up. You know, by the end of the year, we believe interest rates will start going up. What should I do? Should I fix my loan in for certainty of repayment and have a variable rate portion so I can reduce that debt as quickly as possible? Absolutely. If that's something that, you know, appeals to you as a borrower, because a lot of people, when they're borrowing money, and specific back to the, you know, Sydney property market, for example, you know, it's so expensive. And so a normal home loan is now probably $1 million, right?
Madness,
or $500,000 is probably not your normal home loan anymore. It is complete madness. I mean, I'm so used to it now to, you know, a lot of borrowers, a lot of first home buyers getting out there and just getting themselves in lots of debt. A lot of young couples and a lot of young professionals that are early in their career, that are growing, that are probably going to earn or, you know, anticipating on earning lots more money.
Yeah.
So are getting themselves into debt and really focusing on, you know, getting their first property. And in that instance, you know, fixing a portion of the debt to give them certainty of repayment, it's a great idea. If that suits you and if you're happy to pay that repayment or that interest rate, although it's probably a bit higher than the variable rate you're getting, then why not? So I've got clients that split halfway just because they just do. Other people, you know, will look at, for example, they might look at the way that they're paid at work. A lot of, you know, if they get commission payments, for example, or bonus payments. So they might fix a portion of their loan and for 2 or 3 years and anticipate over the next 2 or 3 years their bonus payments will be X amount of dollars and that they would like to put it towards their home loan. So therefore they'll have that portion of their projected bonus as a variable rate so they can put it straight into their home loan, but also have the repayment certainty with the fixed rate. Just really depends on everyone's unique circumstance. And that's why going to one lender, you know, for example, that self-employed customer that's got, you know, 12 months of fantastic year and walking into just a normal branch, you know, they probably will be sent away and then they'll think, oh, I've got to have another 2 years before I can borrow money, where in actual fact there are lenders out there that can potentially help them.
Which is comforting, right? Because if you really want to own a house or at least, you know, get in, you want to make the effort, but your circumstances are odd, like you don't have a proper 9 to 5 where someone's paying you a salary. It's not impossible, right?
No, it's not. And you know, and everyone's situation is so unique. And even just having discussions with me, a lot of my clients have initial discussion with me and get an understanding of what their plans are and what they want to do. And it might not work today. They might walk away and go, oh, you know what, Betty, we might just save a little bit more because at the end of the year we're going to have X amount of dollars. We know we can borrow a lot of money, but our deposit is probably limiting us to the property that we can buy and we'd prefer to wait.
Yeah, right.
And then they come back to me, like in 12 months' time, I'll, you know, hear back from them and they're ready to go. Or, I guess it's just having those discussions, I think, with someone that can help you with your planning. It's a really good thing to do and it's free actually.
Yeah,
so,
right. Yeah.
I can't believe people don't do it.
Just do it.
Yeah, it's free advice, right? So,
yeah, you'd be mad not to give it a crack.
Yeah, exactly. Property's definitely an exciting place to be. And if you're planning on purchasing property, planning for it is certainly, and researching the market and understanding what's available to you is so important. And most of my clients are just time-poor professionals that don't have the time to do the research but want to know that they're getting the best product, you know, the best rate for them. And that's what I do. That's what I love to do. So, yeah.
Let's go and see Betty.
Yeah.
See Betty. Well, Betty, there's been a lot in this episode, but also I think a lot of potential and thought-provoking stuff that people who want to get in and start looking at owning their own property can start writing down notes, doing that research, and also having that conversation with you as well.
Yeah, 100%. Myself or any mortgage broker, I highly recommend you having those discussions. It doesn't cost you anything, but can assure you you'll walk away with so much knowledge, and at least you'll have a plan, if not a home loan or an investment home loan or a bank.
Very least a plan.
Yes, you'll have a plan.
Very best a house. Great, fantastic.
Yes, that's
Betty,
exactly right.
Thank you so much.
It's my pleasure, Leah.
Betty Preshaw's expertise and knowledge is part of HLB Mann Judd's personal wealth management services. For further information, please visit our website hlb.com.au.